Well, 2026 is here, and it is our annual Outlook video where we go over some of the key items that will really go a long way in determining how the markets perform. We got a lot of good stuff to cover. Let's dive into it. Now, before we get into our outlook for 2026, just a reminder, last week we put out our video on our 25 recap. Now, you got to get over listening to me for 15 minutes, talk with a very hoarse voice. If you can get past that, there was a lot of good information in there. Today, though, we're shifting, looking forward. And when we talk about the markets in 2026, we always start by saying there are going to be things that happen as we go through the years that are unexpected and can come out of nowhere. That's a key part of why we're here for our clients to help guide them through those things. Now, as for the key data that will tell us a lot about 26, we have to start off talking about earnings growth. A big story last year was that each quarter, company profits came in much higher than what forecasts were for. As we sit here at the start of 26, right now, analysts are forecasting, you can see there on the far right, 15% profit growth next year. That would be a remarkable achievement if that comes to fruition, or even we come in farther ahead. We will, of course, cover this. We every quarter tell you what you need to know about earnings, and we cover all industries. Now, the next item to pay close attention to is GDP growth. How is the economy doing? What does growth look like there? What the chart you have in front of you is over the last year, taking a look at what forecasts for 2026 GDP growth are. And you can see that there was a period here where this was declining consistently last year. And then in the last 5-6 months, this has been going up, just crossed over 2% growth for next year. Listen, it's been 3-4 years in a row where the economy has grown at a faster clip than what was forecast. And if we give you a comparison, second quarter last year growth was 3.8%, third quarter 4.3%, and right now projections for the fourth quarter 3% growth rate. We would take the higher side here of the 2% number for next year. Pay close attention to that. Now, the last item here, talking about GDP growth, I just want to give you a comparison to what is expected from Europe. And economists, you can see basically for the last couple of years, their 26 number has been going sideways. As of right now, estimates from Bloomberg, 1.2%, from Goldman Sachs, about 1.3%. I mean, that is much lower than the US. And this is one of the reasons why we have very little allocation to international stocks. Yes, they can have some years where they perform better than others. Last year was one of those years, but consistently, they are not going to do as well as the US because the growth just isn't there. By the way, we did a video 2 weeks ago called Portfolio Red Flags. I did with Jonathan Brummel, an advisor I hired here a couple months back. And if you go to our website, you can request a copy of Portfolio Red Flags to be sent to you. It's basically taking a look at what are some of the things when we look at statements from potential clients that we look for that are red flags. Well, one of them is a significant allocation to international stocks, and this is why. Go check that out. So GDP growth and earnings growth are going to be very critical for next year to determine how the stock market does. This is a good time, speaking of the stock market, to talk about what do a lot of the Wall Street strategists think the market's going to do next year. We like to do this every year, and then at the end of the year, we take a look at how accurate were these strategists. As we film this here in early January, the S&P 500, you can see in the very bottom in red, 68.58. And these strategists right now have a target for the end of 26. And you can see there is a wide range here of anywhere between 7,000 up to 8,100 up at the very top. The average in red there in the middle, 75.55. Now, let me tell you something that's very important. Going back 100 years, the average return for the stock market is between 8 and 10% in that range. So it's not a surprise that if you take a look here, there are a lot of these firms who are basically taking what the average has been and stamping it onto what the number is now, and that's how they arrive where they get. And so a lot of them are bunched together here. We think this is a problem because there's a lot of people who invest their money based on what these numbers are. And we still believe there is a good chance that the markets outperform these numbers. If you take a look up at the top there, you have Deutsche Bank, Morgan Stanley, Wells Fargo. We applaud them because they're actually risking their neck a little more. They're stepping out instead and just doing what the average is. So we applaud them, even if they end up not being right, because it's so easy to just blend in with the crowd. That's one of the advantages clients have in using us. We don't have to worry about that. Now, one other item that I want to mention here takes a look at the S&P 500 returns from 1950 up through 2024, 2025. And you can see there it says an average year isn't so average. And this was from Carson Group. Ryan Dietrich, he does a great job. He's an analyst because you would think if the market's average between 8 and 10%, there's a lot of years where the market's up 8, 9, 10%. But that's not the case. In fact, over basically 75 years, you can see there in the tan color, there have been only 4 years where the market was up between 8 and 10%. So what's the takeaway? The takeaway is oftentimes when the market's up, it's up 12, 15, 20, 25%. It does really well. And then there are some years where it is down. In general, about 3 out of every 10 years, you get a down year. So this is just important to understand because if you have portfolios and you look for, hey, I expect the market's going to be up between 8 and 10%, oftentimes that's just not the case. So one of the items that a lot of the bearish analysts, those who are negative on the market, have said actually for the last couple years is that the market is overvalued. PE ratios, that's price over earnings, are too high, and so therefore the market should be going lower. Well, we came across a chart that does an amazing job of breaking down that claim because the basis of it is that over the last 75 years or so, on average, the markets have traded at a PE ratio of 13, 15, 16 times earnings. And so now, looking at 2026, that number is 22, and that's high. We have a great chart. This takes a look and compares companies and how profitable they are. Because look at the bottom of this chart, forward profit margins. This takes a look from 2000 to today. And I want to point out that profit margins we're talking about for every dollar in revenue that a company makes, how much drops down in his actual profits. So for example, if that number is 7%, that means 7 cents for every dollar drops down. And those profit margins were between kind of 7 and 10%, as you can see there, from 2000 all the way over to really 2016, 2017. And then this number has been going up and is right now at nearly 15%. Now, the main reason for this is that a lot of the tech companies that you can think of, the really strong performers that the stocks have done well, they are very, very profitable. And if you're comparing these companies that are really well run to companies back in 1970, 1980, there just isn't much of a comparison. On your screen now takes a look at the makeup of the S&P 500. In 1980, in orange, manufacturing, 66% of the market cap of the S&P was manufacturing. On the far right, 2025, that's now only 17%. On the flip side, on the far left, innovation, which that's tech, comm services, that's communication services like Google and Netflix are in there, was only 14%. Now on the far right, that's basically 50%. So going back to that first chart, maybe the PE ratio of the market was 15 back in 1980, but those companies weren't nearly as profitable as companies today. So companies today should have a higher valuation. So on the top, this is an adjusted PE ratio, adjust companies for their profitability. And that shows when you do that, and that's in green, by the way, on the upper part here, that is now at 16.5, and you can see that green number is kind of right in the middle of where it's been over the last 20 years. This is a very important chart. Anytime you talk to somebody who says, hey, stocks are too expensive, they should be going down. Now it's time for rapid fire. And this is where we go over some key charts we think you need to know about. And this is a version looking ahead to 2026. We're going to start off talking about capital expenditures around AI. And what we are talking about here is a big question is the big hyperscalers, Amazon, Microsoft, Google, Meta, and there's some other big tech companies also have been spending a lot of money building out their AI capabilities, data center, chips, etc. In fact, if you take a look at those big tech companies, you'll see over the last 4 quarters, they're in the middle. You have $107 billion spent by Amazon, $93 billion Microsoft, $60 billion Google, and $65 billion Meta. And then on the next column for calendar 2026, these are estimates. Take a look at the big jump. These companies are continuing to spend. Now, why does this matter? Because there are a lot of people wondering, hey, is this money well spent? Or are these companies spending too much? Does it remind us of the telecom build out of the dot-com era? We think that's not the case. And again, we've talked about that these companies are very, very profitable. A lot of the telecom build out were by companies losing a lot of money who were issuing debt to pay for it. But nevertheless, we will be paying close attention to these companies in 26 to see what is their profitability look out with all this capital expenditure. Okay, the next chart here is looking at the Fed funds rate. This is around the topic. Jerome Powell has been the Fed chair now for quite some time, but in May, we are going to get a new Fed chair. We'll talk about that next year. Why that matters is the president wants rates to be cut a lot more. Right now, the markets are pricing in, you can see the Fed funds rate in purple. That is showing on the far right that they expect it to be just above 3%. Where things are right now are at 3.64. So the market's basically pricing in 2 rate cuts next year. We think the new Fed chair probably is going to cut more than that, okay? So this is going to be something to pay close attention to because it moves markets more than just about anything else in the short run at least. All right, next topic is looking at under second term presidents, how do stocks do? Here's what we're getting at here. In the first year of a presidential term, the markets have done really well since we hit the year 2000. In fact, 6 for 6 the first year, average gains oftentimes above 20% in the first year. But the second year has been tougher. Go back to 2022, markets did not do well. And in 2018, they did not do very well. But both those occasions, we had rate hikes taking place. Now we have the Fed cutting rates, so there may not be great comparison there. But what this chart you're looking at does, and you can see they're highlighted midterm year, this is in a second term of a president, which we have up above In blue, in the second term of a president, 8.8% average gains versus first term, basically no gains in the second year. So hopefully that will carry through this time. Now, my last chart here for 2026 outlook in rapid fire, we are looking going back to 1980, and this is very important, at the stock market and how it's performed. But it's also taking a look at what kind of a sell-off took place during that year. Why this is important is that in 2026, there are going to be some storm clouds that come along the way. There are going to be periods where the stock market has a sell-off. Last year, as an example, we had a sell-off of over 22%. Back in March and April. And if somebody sold off then, they missed one of the best rallies from the low then to the end of the year that we have seen. Now, what you're seeing here in blue is the return for each calendar year the stock market had. There are some years where it's negative, and you can see the blue line goes lower. And then in brown is during each of those years, what was the biggest sell-off that the stock market had? So why, again, this is important is you can see on average in this period, the stock market has gained over 10% per year, but on average, there has been a decline somewhere along the way of over 14%. In some years, it has been much, much worse than that. So again, when the storm clouds come, this is telling you stick in there. And in fact, the best thing to do is do some buying, not selling. Okay, so the key takeaway that in 2026, the Fed is expected to continue cutting interest rate. Strategists and economists believe the U.S. economy is going to grow at a good clip and earnings are going to grow at a great clip. That combination is typically a good mix for higher stock prices. Listen, if you are new to Centera and you haven't seen us before and all of this talk about investing is a little bit too much, reach out to us and we would love to talk to you. You can go to centeracapital.com, go to the contact page, reach out. We can have an initial phone conversation and we have a 3-meeting process to see if we are a good fit for each other. Well, thanks for watching and here's to a great 2026.